So if you think that as an expat, you can work short stints in Namibia without actually being liable for tax, I've unfortunately got bad news for you. The Act is very clear that when you work in Namibia and that service is rendered in Namibia and you get paid for that, you are subject to tax. If you perform work in Namibia, you are taxable here. Unless there's a relief under one of the double taxation treaties, you will be subject to tax. A number of things. Obviously, we've got peace and stability. We've got quite a simple tax system compared to other jurisdictions. And then, of course, the big hype about the oil and gas that's been there. There's the green hydrogen that people are speaking about. The minerals are very strong. And then there's good opportunities investing in tourism and logistics. So I think if investors look at that and they see a stable country in Africa as a footprint into the rest of Africa, I think it's quite attractive for them. One that we often find people don't understand it well is the fact that we are a source-based tax system. That means that you only get taxed on activities that happen in Namibia. Now, very often people come with the perception that they can operate here if it's for a short period of time and that there's no tax liabilities due. That, however, is only applicable if there's a country with which we have a double tax agreement. So investors often get caught off guard when you tell them you've been operating in this country for 3 months, it was just a short project, and all of a sudden there's a tax obligation that they didn't know. And that usually creates quite a bit of unhappiness on the side of the investor because they were not aware of this. But if you do the research up front and you speak to experts, that's one of the first things that they point out to you is that, remember, we are a source basis of taxation, meaning that if you operate in this country, there's taxes due. No, so I mean, the tax systems are the same. There is a different tax act regulating the oil and gas space. It's called the Petroleum Taxation Act, but it only applies to people that own the licenses. So subcontractors, so for instance, owners of vessels or people performing services in the oil and gas industry, they fall under the normal Income Tax Act. The oil and gas sector, when it comes to the actual operators of the licenses or the owners of the licenses, they've got the Petroleum Taxation Act, which works a bit differently, but also still on source. And it's important there that, yes, there's different rates. There are certain exemptions. For instance, you don't pay dividend withholding tax if you are mining for natural oil and gas. So there's an exemption in the Income Tax Act for that. But apart from that, the rules are the same. There may be a relaxation of certain rules, especially when it comes to foreign exchange control, which the Bank of Namibia has given. But apart from that, expats working here on a short stint are subject to tax. Very often, the employers would carry that cost. So they would say, as an expat, you earn $10,000 a month, irrespective of where you work in the world. And then they do what we call a gross-up calculation to say, this $10,000 you get in your pocket. Your employer carries the tax on that. So effectively you're earning, let's say, for example, $13,000 and the employer pays over that. While we're on the topic of oil and gas, I think also important to understand that there's very specific inclusions in the Income Tax Act for the mining sector and for the oil and gas sector, that if there's any direct or indirect disposal of a license, meaning an oil and gas license or a mining license, or the rights or a share in a company that holds such a license or right, that sale triggers, or that disposal, or that triggers a tax liability. And people will say, yeah, but nobody will know. But I don't think that's the right attitude. The fact is, if you are sitting in the US and indirectly you own a share through a company in a Namibian oil block, and the US company sells that, you are liable for tax in Namibia on that. There are certain exemptions when it comes to double taxation agreements. That gets quite technical, that you can get away from that, where shares are, in terms of the treaty, treated as movable property. But that gets quite technical. So I don't think we'll discuss that in too much detail today. So South Africa is firstly a lot more complex. They have capital gains tax, they've got donations tax, they've got estate duty, and they work on a residency basis, which means that basically a South African company gets taxed on all their profits worldwide, or a South African individual, whereas Namibia is only the source basis. So there's quite an important distinction for people to understand that it's a lot different than South Africa. Yes, it's based on legislation that was in the early 19s in South Africa, so it's based on that. But then apart from that, there's really limited guidance in Namibia in terms of things like practice notes or interpretation notes. So it's quite difficult if you don't know the environment, you don't know what's happened in the country, to be sure of what's going to be the tax effect if you don't speak to the right people. Definitely before. That is a must. If you want to lose money or you want to have unpleasant surprises, you do that after the project has started. Unfortunately, the way business works, and if you've got a sales team and a commercial team or business development team driving your business, they very often forget about the tax side. And if you don't know about the tax side up front, it comes to bite you later on. You have unexpected tax obligations, you've got liabilities, and you're completely exposed in terms of the cost of the project, which then often is not what the commercial people said it would be. And then your margins erode, and then people get upset because the project is not as feasible as they once thought it was. A couple of years ago, the concept of the digital nomad visa by NIPDB was launched, but I mean, that doesn't take away the tax liability. The fact that you get that visa doesn't mean you are not taxable in Namibia. You are still taxable because we source operated. So if you come here for 3 months, let's say you come from the US and you want to spend your portion of your summer here, those 3 months that you work here will probably be taxable. Because source is all about where do you employ your skills, or where do you physically perform the work for which you get paid. People are very often under misguided assumptions that as long as I get paid offshore, I'm not taxable in Namibia. But that is simply not true. If I sit and I play with shares and I trade and sell and buy and sell and make a lot of money, or with crypto, but I'm applying my skills while I'm in Namibia, it doesn't matter if I get paid in the US, I'm still subject to tax in Namibia. And I think that's important that people realize that, because that often, if you get picked up on something like that you didn't declare, remember, it's not only the taxes, there's also penalties and interest that gets added. And then all of a sudden your 100,000 tax liability could become 300,000. One of the important things about expats coming here is that the law is very clear. If you work in this country, you have to pay as you earn. Unless there's a treaty in place with another country which provides that country with a taxing right. And usually that is if an employee is here for less than 6 months, they get paid offshore, and the company that is employing them does not have a physical presence or a permanent establishment in Namibia. Only if all 3 requirements are met does the expat not become liable for tax in Namibia. A couple of years ago, there was a suggestion by the NIPDB that we should launch something like a visa that you can work here remotely without paying tax. Unfortunately, that rule from the tax perspective has not been passed, and people will therefore thought that if you have this remote working visa, that you don't have to pay tax in the country, which is unfortunately not true. So I think it goes back to the fact that we have to consider the fact that Namibia is a source basis of taxation, and that any investors coming here performing services, so there's a specific clause in the Income Tax Act that talks about services. If you render services in Namibia, you are subject to tax on that. If you're an expat that gets sent here for a month or 2 or 3 months, you are taxable in Namibia. That is the first rule to really be aware of. You can get relief under a double taxation treaty if that is in place with your country. Important that we do not have one with Canada. There's often the perception that there's a treaty with Canada in place. It's not been ratified by the Namibian government. So Canadian businesses, American businesses, Spanish businesses, everybody with who we don't have a double tax agreement that operate in this country, even if it's for a short stint of time, is subject to tax. And it doesn't stop with the individual. It goes further to the company, because the employee is representing the country, and the moment that their service is rendered, that triggers a tax liability, a potential tax liability for the company as well. And that often gets overlooked, and it's a nasty surprise to realize. So the cost of not planning properly is firstly, as I mentioned previously, you are going to incur a tax liability. And that tax liability often then erodes the margins on the project. And it could lead to substantial penalties and interest. NAMRA is currently quite aggressive in how they apply certain provisions of the Act. And if you did not take into account that there's a certain tax leakage on a project, that is going to come bite you. I think important for investors also to understand is we don't have a statute of limitation. So NAMRA is able to go back. I mean, recently we've seen them going back as far as 10 years. And if they pick up something now, and you've been paying, for instance, practically service fees to a jurisdiction with which we don't have a double tax agreement, and now they come and say, well, for the last 10 years, you've paid services fees to a company in the US, and you add a 10% charge on all those fees, that that can erode not just the profits, but sometimes the whole balance sheet of the company, because the amounts do get substantial. I don't think it's as such the obligation. If you operate in this country and you know the tax obligations, there's the monthly filings and the annual filings that you should be aware of. But what often becomes a pain point is just the speed of which things get resolved if there's a query on your account. If there's, for instance, a VAT refund or income tax refund, you have to realize that that takes a significant amount of time. From experience, income tax refunds can easily take more than a year. And that's cash that's locked up and you cannot use it. So it hampers the investor's ability to use his own cash that's due to him to grow future projects or do further investment into Namibia. The other one that's a pain point is, especially if you look at large infrastructure projects where they import equipment or, let's say, solar panels. The moment those goods enter Namibia, there's the import VAT charge. You pay that import VAT and you can claim it back in a VAT return. But the moment that you are in a refund position, that triggers an audit. And if there's an audit, there's a whole process behind that. And unfortunately, the money that's really due to you because you paid the money, you just need to get it back. That timing difference often runs 6 to 9 to 12 months, which really is a big problem. So we're hoping that there will be rules in the future that the Ministry of Finance will introduce when it comes to tax policy changes that sort of provides relief, specifically in certain industries where it creates a big problem. The important thing about a tax treaty, it's called a double taxation agreement or a double tax treaty. What it does, it allocates profits between two countries that want to tax the same profits. So let's say a South African company comes to Namibia and they construct roads here. From a South African perspective, because they work on a residency basis, they are subject to tax on all the profits that they make worldwide. So that includes Namibia. Namibia, as I mentioned previously, is a source country. So they say, guys, if you want to operate in this country, you have to pay tax on the profits that you make here. So now you've got the situation where two countries want to tax the same profits. And that's where the double taxation agreement comes in. And that double taxation agreement basically allocates rights to different territories, so between South Africa and Namibia. And often you'll hear the concept of a permanent establishment or a fixed place of business. And that is one of the first things that you have to analyze when you do work in this country, if you come from South Africa, for instance. Because that will tell you if you have something like a warehouse or you've been operating here for longer than 6 months on a service project, that gives Namibia the taxing right on those profits. So double taxation agreements are such a powerful tool for investing. And unfortunately, we've only got 11 in place. We're hoping that treaty network expands, because the more you get foreign investors coming to this country, one of the first things they want to know is, what does the treaty network look like? If you look at some places like Mauritius or South Africa, you've got more than 50 treaties, which means that investors coming there got a better chance of optimizing their tax structure and investing their money in Namibia into new projects. The double taxation treaties, for instance, also gives reduced rates on things like dividends, interest, royalties, and services fees. So as an investor, if you're investing into Namibia from South Africa and you want to take out dividends from Namibia, you declare dividends back to your shareholders, and as a company you earn more than 25% of the share capital of the Namibian company, your rate automatically reduces to 5%. So that's a massive difference between the 5% and somebody not coming from a treaty country, which will pay 10 or 15%. So treaties are such an important tool to optimize investment and to attract investment further, to develop our economy. You have to speak to somebody on the ground, you have to speak to people that know what's going on in this country, and you have to get proper tax advice. I've so often seen people operating on certain assumptions that, yes, you can come in if you're here for just a month or two, nobody will ask questions, and it's done. But it gets a lot more complex than that. So I think as an investor wanting to invest in Namibia, make sure you do your homework, because there are a lot of assumptions people make, and assuming that the way the rest of Africa or the rest of the world works with short-term assignments is also applicable to Namibia. And that's unfortunately not the case.